All right, let's get right into it. If you're investing in commercial real estate, you've got a huge choice to make. I mean, a really fundamental one. Do you want to be the lender, the one playing it safe and getting that steady paycheck? Or are you the owner, the one who's chasing those massive returns, but you're also taking on pretty much all the risk? That's the big question, and it's all about something called the commercial real estate capital stack. So let me just throw this out there to get us started. What would you pick? A pretty safe, predictable 6% return? Or would you take a shot at a huge 57% gain? Now here's the catch. That 57% gain could just as easily turn into a 57% loss. Sounds crazy, right? Well, stick with me, because by the time we're done here, you're going to see exactly how both of those scenarios can happen in the exact same deal. So how do we make sense of that choice? Well, it all comes down to this concept called the capital stack. You can basically think of it as the financial DNA of a building. It shows you where every single dollar came from to make the deal happen. But here's the thing. It's not just a big jumble of cash. It's a very specific layered structure. And the best way to think about it, honestly, is like a building. Down at the bottom, you've got the debt. That's your solid, concrete foundation. It's the safest part of the whole structure. And then way up at the top, you have the equity. That's the fancy penthouse suite. It's got the incredible views if everything goes right, but it's also the first part of the building to get hit when a big storm rolls in.
Okay, so let's start with that foundation, right? We're going to put on our lender hat here. If you're a debt investor, your whole world, your entire mindset revolves around one single idea: keeping your capital safe. And you can see that risk profile laid out right here. The most important phrase to remember is priority of payment. It's everything. As the debt investor, you are first in line, period. First in line for any cash flow the property makes, first in line to get paid back if the property is sold. The equity owner, they're dead last. They are the ones who have to absorb the first dollar of any loss. And you know what that does? It creates this nice protective cushion for you, the debt investor. Now, of course, that safety comes at a price. It's a trade-off. If you're the lender, your return is fixed. It's capped. The property could become the most profitable building in the city, and guess what? Your return doesn't change one bit. But the equity owner, well, their potential is unlimited. They get all of that upside. This really gets to the heart of the two mindsets. The debt investor is focused on the return of their money. They just want their principal back plus the interest. The equity investor, they're all about the return on their money. How much can they make it grow? Okay, so let's climb up that building right to the top floor. We're heading to the penthouse to check in with the owners, the equity investors. These are the folks who are willing to take on the risk. They want that incredible view, and they're fully aware of what it takes to get there. And this chart, this gives you the whole picture, the full spectrum. You see at the very top, you've got your senior debt. That's the safest spot, first in line, targeting a nice, steady 5 to 7%. But as you start moving down the stack, through things like mezzanine debt, preferred equity, and then into different flavors of equity, you're taking on more and more risk. And for taking on that extra risk, what do you get? You get the potential for a higher return. It just keeps climbing, all the way up to 20%, or even more for those really aggressive, opportunistic deals. So you're probably asking, how on earth does equity get those kinds of crazy, supercharged returns? Well, there's a secret ingredient, and that secret ingredient is called leverage. This is the magic, or sometimes the curse, that can take a small change in a property's value and just blow it up into a massive swing for the equity investor. Okay, to really see this in action, let's just use some simple numbers. Let's say we buy a property for $10 million. Pretty straightforward. We get a loan for $6.5 million, that's our debt from the lender, and the rest, that $3.5 million, that's our money, the owner's equity. All right, now pay close attention. Scenario 1, things go well. The property's value goes up by 20%. A solid return, but not, life-changing. The debt, it stays exactly the same, $6.5 million. But look what happens to the equity. It shoots up from $3.5 million to $5.5 million. Now let's look at the other side of the coin. Scenario 2, the property value drops by that same 20%. Again, the debt is totally fine. It's insulated from that loss. But the equity, it gets absolutely crushed. It plummets from $3.5 million down to just $1.5 million. The lender is just humming along, collecting their 6% either way. The equity investor, though, they're on a wild roller coaster. So think about that. Just a 20% bump in the property's value turned into a massive 57% gain for the equity. That's leverage working its magic for you. But, and this is a huge but, it is a double-edged sword. That exact same 20% move, just in the wrong direction, delivers a devastating 57% loss. You see? Leverage doesn't care which way things are going. It just amplifies the results. And that's the key takeaway right there. Leverage is like a giant amplifier hooked up only to the equity position. It makes the good times great and the bad times terrible. All the while, the debt investor is just sitting there, collecting their fixed return, totally insulated from all that drama. As long as, and this is important, as long as the property's value doesn't crash below what they're owed. Okay, so this isn't just some textbook theory. Far from it. Understanding this push and pull is absolutely critical, especially if you're paying any attention to the real estate market right now. So let's bring this into the real world. Right now, that entire capital stack we've been talking about is feeling the pressure. For one, interest rates are up. That makes new debt way more expensive, and that extra cost, it comes right out of the pockets of the equity owners, squeezing their returns. And this is all happening at the worst possible time, because a ton of old, cheap debt is about to expire. And when I say a ton of debt, I mean it. People are calling it a maturity wall. We're talking about more than $1.5 trillion in commercial real estate debt that has to be refinanced very, very soon. So if you're an equity owner, you're facing some really tough choices. Do you sell, maybe even for a loss? Or do you try to find some new, very expensive money to plug the hole? And for the debt folks, well, it's a mix. It could be new chances to lend money at higher rates, but it also means a bigger risk that some of these owners just won't be able to pay them back. And all of this brings us right back to where we started. In today's market, with high rates, all this uncertainty, where do you want to be? Do you want to be down in that solid, predictable foundation as the lender? Or are you willing to brave the storm up in the penthouse, knowing you're exposed, but hoping you still get that incredible million-dollar view? There's no right answer. It all comes down to how much risk you're willing to take.